Central Bank of Nigeria yesterday reported a substantial improvement in its net foreign exchange reserve position as of the end of 2024, reflecting better liquidity, reduced short-term obligations, which should lead to a boost in investor confidence. We discuss a note on this by Tilewa Adebajo, CEO, CFG Advisory. Later today, the U.S. administration will be presenting its reciprocal tariff policies at an event tagged Liberation Day, expected to move markets. We also preview the possibilities. Also on tariffs, U.S. Treasury Secretary Scott Bessent said late yesterday that the amounts announced today will be the highest the tariffs will go. However, countries could then take steps to bring tariffs down as negotiations progress. The tariffs would take effect immediately and expected to be milder than initially thought. President Tinubu has removed the chairman, Chief Pius Akinyelure, and the group chief executive officer, Malam Mele Kolo-Kyari, in a sweeping reconstitution of the Nigerian National Petroleum Company Limited Board. The new 11-man board has Engineer Bashir Bayo Julari as the group CEO and Amadu Musa Kida as non-executive chairman. Bayo Julari was managing director of Shell subsidiary SNEPCO from 2015 to 2021. Hello, welcome to Global Business Insights, where we look deeper at the business stories all over the world. Nigeria's foreign exchange reserve stood at $23.11 billion, the highest level in over 3 years, also a marked increase from $3.99 billion at year-end 2023, $8.19 billion in 2022, and $14.59 billion in 2021. The reserve position, which adjusts gross reserves to account for near-term liabilities, is a more accurate indicator of buffers available to meet immediate external obligations. Gross external reserves also increased to $40.19 billion compared to $33.2 billion at the close of 2023. The increase, according to the note by Advisory CFG, reflects a combination of strategic measures taken by the central bank, including a substantial reduction in short-term foreign exchange liabilities, notably swaps and forward obligations. It was also due to rebuilding confidence in the FX market with recent improved foreign exchange inflows, particularly from non-oil sources. The result is a stronger and more transparent reserves position that better equips Nigeria to withstand external shocks. The expansion occurred even as the central bank continues to reduce short-term liabilities, thereby improving the overall quality of the reserve position. Governor of the Central Bank, Olayemi Cardoso, commented that this improvement in the net reserves is not accidental and indeed is the outcome of deliberate policy choices aimed at rebuilding confidence, reducing vulnerabilities, and laying the foundation for long-term stability. The central bank anticipates a steady uptick in reserves underpinned by improved oil production levels and a more supporting export growth environment expected to boost non-oil foreign exchange earnings and diversify external inflows. Also remaining committed to prudent reserve management, transparent reporting, and macroeconomic policies that support a stable exchange rate, attract investment, and build long-term resilience. EVI has observed the consistency in monetary reform, not just in eliminating the parallel and official market gaps, but introducing improved ethics and transparent processes which builds confidence for investors. Beyond portfolio and money market inflows, for foreign direct investment to come at the desired levels, vast improvements in infrastructure, security, and price stability will still be required to complement a healthy foreign exchange reserves position. On today's tariff announcement, White House aides are reported to have drafted a proposal that would levy tariffs of roughly 20% on most imports. But the final levies could be anyone's guess, as several options are said to be on the table. There was also speculation around a country-by-country reciprocal approach, which will factor difference in tariffs and net volumes of trade. Treasury Secretary Scott Bessent has been singling out what he called the Dirty 15. The 15% of countries that trade heavily with the US and have high tariffs. Kevin Hassett, who is director of Trump's National Economic Council, also said the administration is looking at 10 to 15 countries that account for America's entire $1 trillion trade deficit. The data shows this would include, that is at the top of the list, China, followed by the European Union, Mexico, Vietnam, Ireland, Germany, Taiwan, South Korea, Japan, Canada, India, Thailand, Italy, Malaysia, Indonesia, Switzerland, France, Austria, and Sweden. We could also see some attempt at staging to allow some flexibility and future review points to reassess the status of ongoing trade negotiations. Tomorrow could also unveil a strategy to bring the Dirty 15 to the table for more talks. We could see much softer hikes to assuage the concern that this is going to worsen already sticky inflation scenarios. The elections in Florida and Wisconsin seem to be a referendum on popularity of Trump's blitz of tariffs, federal layoffs, and deportations could prompt a check of sorts if, for example, Republicans don't perform as well as expected, but perhaps not lead to a complete policy reset. Across the pond, in the UK, Prime Minister Sir Keir Starmer has acknowledged the UK was unlikely to be spared despite the close transatlantic relationship and efforts to strike a limited trade deal. Still, he argues that it calls for a calm and collected response, not a knee-jerk, and nobody wants to see a trade war. European Commission President Ursula von der Leyen said all options are on the table in response to tariff threats, saying while the EU does not want an economic conflict, it has the power to push back. Still, von der Leyen has said the European Union, though they have a strategy to retaliate, are looking for a case where they are able to negotiate. Stocks will be relieved if today's announcement brings more certainty and stability, calms the worst-case expectations of a bitter trade war, and hopefully we see something that is much more manageable than many had been expecting. Markets may already have priced in most of the tough news, but that is hard to say. The consensus seems to be that we will get at best a shallow recession in the world's largest economy as the policy shifts take its toll on consumption and dampens trade. At the last Fed meeting, members of the FOMC signaled 2 rate cuts in 2025. The most likely case, some say, may be optimistic, could be that a mild hike upholds this projection. The S&P 500 climbed yesterday amid much volatility as the market awaited clarity from Trump regarding tariff policy rollout. Wall Street also faced some pressure from weaker than expected economic data. The ISM manufacturing PMI fell to 49, that is in the US, in March 2025 from 50.3 in February, below forecasts of 49.5. The reading pointed to the first contraction in factory activity in, say, 3 months after expanding only marginally in February. Demand and production retreated and the staffing continued. Companies also see unclear demand patterns, many holding back for better clarity on government policy shifts. Prices growth accelerated due to tariffs, causing new order placement backlogs, supplier delivery slowdowns, and manufacturing inventory growth. Also, in the US, the number of job openings was little changed at 7.6 million in February. Also over the month, hires and total separations held at 5.4 million and 5.3 million respectively, while quits, layoffs, and discharges changed little. Artificial intelligence startup CoreWeave's shares were up 17% at $43.5 on their third day of trading on Tuesday, above their initial public offering price of $40. AI infrastructure firm CoreWeave had already taken a hit in that it had to downsize its IPO. The Eurozone's annual inflation rate was 2.2% in March, down from 2.3% in February. The European Central Bank, which has cut interest rates 6 times since last summer, will decide whether to lower it again at its next meeting on April 17th. The ECB aims for an inflation rate of 2%. Vehicle sales at China's BYD up 58% in the first quarter of the year. This comes in a stark contrast to an expected fall in demand for Tesla's electric cars as Elon Musk's brand continues to face a backlash in US markets. The Shenzhen-based group yesterday said it delivered 986,098 passenger vehicles in the first quarter, of which 416,388 were pure electric vehicles. South Africa's two biggest political parties, the ANC, African National Congress, and the pro-business Democratic Alliance, were reported not yet to reaching agreement on the country's budget yesterday, since the issue of a VAT hike became hard to resolve. Still on South Africa, a South African PMI survey recently showed that conditions in the manufacturing sector remained depressed in March. But there was a slight improvement in sentiment thanks to better demand. The PMI South Africa rose to 48.7 points from 44.7 in February, but still in contraction. JP Morgan is reported to be transforming its representative office in Lagos into a fully fledged business branch, marking a further step in its CEO's strategy to strengthen its presence on the African continent. The new merchant banking entity, when approved, will be able to offer advisory and asset management activities as well as dollar loans to its clients in the country. Shares of Hong Kong-based conglomerate CK Hutchinson rose 1% yesterday, slightly lower today, driven by uncertainty ahead of the company's expected deal to sell its Panama port assets to a BlackRock-led consortium. The agreement, initially scheduled to be signed today, is facing a lot of political scrutiny and resistance from Chinese regulators as Chinese media label the move a betrayal of its national interests. Ryanair has emerged as the first European airline to carry 200 million passengers in 1 year. Ryanair flew 200.2 million passengers in its fiscal year to the end of March. It has also cut its forecast for the coming year for the second time in 3 months in January to 206 million passengers from 210 million due to Boeing aircraft delivery delays. Asia-Pacific markets were subdued as investors braced for rollout of fresh U.S. tariffs this week. Yesterday, Brent Standard crude oil price reached the $75 per barrel mark for the first time since the end of February. Analysts don't see it going higher because the gradual reversal of the voluntary production cuts by OPEC Plus members is just beginning, and that will increase the oil supply by close to 140,000 barrels per day. Today, Brent is flat at around $75 a barrel. Gold prices continue to extend gains today after a record high in the previous session as investors sought the comfort of the safe haven metal in anticipation of the potential impact of U.S. reciprocal tariffs. Yesterday, bullion touched an all-time high of $3,148.88 an ounce. Well, that's all on this episode of Global Business Insights. Thanks for watching. This is Bode Oshosami. Bye-bye.